Very good afternoon. You're watching the newsroom right here on ET Now. I am Ajay Sharma. Markets are trading flat, but below the 12,1300 level, 19,300 level. That's what Nifty is trading. And Bank Nifty also lackluster. Pull up the mid-cap, small-cap indices. You would see a relative outperformance out there. No, today even the mid-cap, small-caps are quiet. This global kind of a risk-off has, in the short term, the near term, making a lot of people nervous. Let's discuss all of this with Vinay Jaising, who's joining us on the show now. Vinay, before we talk about portfolio strategy and various sectors, in the last 48 hours, the kind of a risk-off seemed to have gripped the world, which is giving some amount of jitters to capital markets. Be it extremely anemic data coming out of China, news is not good. US, every now and then banks are coming on the receiving end, or rating agencies and etc., making a lot of people uncomfortable, and data also suggesting more hikes there. Do you think this could trigger a near-term bout of risk-off globally, and we could also buckle under pressure?
So I'm pretty confident that a risk-off trade is much overdue for the world. The reason I say this is, if you look at just YTD, Nasdaq is up 30%. Most of the indexes are up between 10 to 15%. Japan is up 20%. And when you're looking at US, you're still seeing a huge slowdown. The 2-year, 10-year chart is negative 8 basis points in interest rates. And the 2-year chart at 4.95% is really close to peak levels. The money supply growth is at probably a 10-15-year low. And we've seen as much as $900 billion being sapped out of US. A similar number of $900 billion being sapped out of China, which itself, as you put it rightly, is having its own set of pain. So yes, the world should be having a risk-off trade, but that's where I think India should gain. Because if you put the story the other way around in India, what is India doing well? India is doing well on the economy front. You see the GST numbers which are coming up. Apart from inflation, CPI which inched up to 7.4%, and here I think on a year-on-year basis, incrementally you'll see inflation come down hopefully to the sub 6% levels, and that should also reduce the pain. You're seeing earnings growth trajectory of India led by banks, capital goods sector doing very well. And FI inflows, if you forget just the last week or two, if I look at just FITD, is up a solid $18 billion, but yet if I look at it over 3 years, we are a negative number. So FI ownership too is low. And if India's GDP purely is growing at 4 times that of the rest of the world, I think the risk of trade should be a big vantage point for India.
Right. Fair point, Vinay. I want to understand, which part of the market is the most resilient in your view. And I would like to know, of course, you have a bunch of stocks in your portfolios, but you may be tracking a larger list, a longer list. Out of the ones that you track as a team, I want to understand which are the ones which have given out most confident commentary on the trajectory of earnings, despite of whatever is happening. If some names come to your mind, purely for example purposes, that there are some kind of companies, even in this kind of environment, braving earnings very well.
Sure. Thanks again, Ajay. So first and foremost, when we are saying India is doing relatively better than the world, the first thing we do at JMPMS is look more domestically. So our exposure to domestic sectors are increasing as compared to our exposure to global sectors, which means we would be overweight capital goods sector, industrial sector, private banks, and relatively underweight spaces like energy and the IT space, where we have to depend a lot more on the exposure to the global part. Having said that, we also think, based on our relation with Russia, as we are now consuming as much as 45 to 50% of our net oil imports coming in from Russia, or as much as 40% of our crude consumption comes from Russia, and that's at cheaper prices. We also think a rupee is going to appreciate as against the dollar. So that again gives us reasons to be a lot more bullish the domestic sector. If I look at earnings, the earnings growth drivers, for the results which have come in so far, you've seen the banks grow as much as 60%. The financial sector has really done well, especially banks. Probably, but this will be one of the last quarters wherein you'll see such a high growth because the COVID provisions are largely behind us. But the loan book growth at 19-20% last couple of weeks, led by retail, and you're seeing slight improvement even in the corporate part, is something for us all to cheer off. So banks in the private space is something which we're excited about. Capex, virtually most of the companies in capital goods or industrials gave us smiles. What I mean to say by that is if you see some companies in the railway sector, the earnings were simply put fantastic, more than doubling of earnings. Companies in the capital goods sector in diesel engines like Kirloskar Oil, their top line and bottom line was again, north of 25-30%, again, giving us all smiles. Pure consumption theme, or if I would call it the FinSum theme, if you would look at SBI Cards or look at Trend's numbers, top line 35-40%, bottom line similar. The way they are increasing outlets, that's all leading to our analysts increasing numbers in these companies, and hence we like these companies. One last comment I would make on this subject would be even petrochemical companies or specialty chemical companies with exposure, indirectly to China or to the rest of the world are now seeing the inventory levels of China being in control. And you're seeing prices of specialty chemicals inch up, especially companies like RK.
Vinay, we've not had a reasonable correction for some time now. Since March lows, I would say, no 10%, 5% kind of cuts in big names. So, the kind of a market environment or the screen which actually drives a shiver down the spine of many of the market participants. Maybe the market got a little complacent. So, every now and then that kind of a market is required to clean the froth. But this time, the way, Goldman just put out a note saying specific flows are going into quality mid-cap by FIS side. First time in 5 years. This time, whenever a decent pullback arises, do you think quality name falls will be cushioned?
Absolutely. So, I'm going back to the comment I made on FII ownership. I'll just give you some statistics. 2.5 years ago, FIS owned as much as 20% of India. And that time we were a $3 trillion market cap country. Today, when they are at $3.8 trillion, they own only 18% of overall India. So you'll see an inch up impact of FIS putting money into India, and as China becomes a bigger problem, the MSCI weightage of 13%, that number can, be, people can bet a lot more on India than what they're already betting. But that's one part of the equation. Please also remember the SIP data is going to extremely high levels on a month-on-month basis, clearly beating whatever your and my estimates ever have been. We've already seen more than quadrupling of the SIP data in the last 5 years, and that's again retail money coming into the country, into the markets, is another big sign. But these are two technical parameters. If you look at the third parameter, which is how the government has changed the budget and focused so much on capex, overall budget on capex on roads, railways, if you look at defense, water, you club all this up together with power, has gone up by about 5.5 to 6-fold in the last 10 years. So all these companies in the capex and industrial sector, they're all small cap and mid cap, and small cap and mid cap indices. If you look at them, between 30 to 50% weightages come from these sectors. That is why, small cap and mid cap is also doing well. But all these companies have an order book of 4 to 5 times, and their earnings are looking way north of 25% on a 2-year CAGR, both on the top line, and EBITDA margins improving means even higher on the bottom line. So we are excited, the water space, the capital goods space, and the railway space. And I think all that being in small cap and mid cap gives you quality names, good balance sheets. Virtually most of them are with cash, and a lot for investors if a risk-off trade is coming on to bet on.
Vinay, what kind of discussions are you having with your clients, the big clients at PMS? Are they in the mood to top up? Do they inquire, should I book out, is market frothy? I want to understand, gauge the sentiment among your, the client fraternity.
So firstly, on asset allocation, a lot of them, are pretty happy that the interest rates for India at the 7.25 levels. And if you look at, some AA papers, you add about 250 basis points of it. So they are getting 9.5% interest rates to invest in or higher for quality paper. So yes, we are seeing some debt allocations happen. That's step one. Second, what we're seeing is if people were a little not convinced on stocks where your earnings visibilities are reducing, we're seeing a lot of them tell us, let's get out of these stocks, let's buy quality names where you're seeing earnings trajectory move up. So a lot of what you didn't want uh, in your overall kitty of assets for equity are getting changed to quality names, but quality names where the valuations are reasonable, but more importantly, the earnings are a lot more robust. So we're seeing these two changes in equity. People who didn't look at, let's say, defense stocks earlier, when they're seeing a quarterly result come out, let's say of Bharat Dynamics, when there was a slippage, miss of results because they couldn't get a supply coming in, for executing their order book, we're seeing the stock slip and then investors looking at that a lot more aggressively and start buying it. One last thing, when we are talking about valuations, please keep in mind that, we are today trading at a 1 year forward valuation of about 20 times, which is way in line with what it was in the last 5 years. But our trajectory, this is the second time, I think, in 2 decades, we are seeing 3 years plus growth of double digits, and incrementally, our analysts are talking about a growth of as much as 19 to 20%. So people are excited about growth companies. They happen to be small and mid cap.
Okay, all right, Vinay, we'll let you go on that one. Thanks so much for joining us. Always enjoy our
you.
conversations. That was Vinay Jaising of JM Financial PMS. But before we take a break, also get you view coming in from one of the India's largest fund, which is in the small cap, mid cap space. We've got Pankaj Tibrewal.